Hi, everyone. Good afternoon. I'm Dr. Zwade Marshall. I'm CEO and co-founder of Doc2Doc Lending. I am an anesthesiologist and interventional spine specialist by training. I know how to put folks to sleep. Hopefully, I won't do that today. I own 3 pain centers across the Atlanta market with 2 surgery centers as well. Now, I'm going to tell you over the course of the next few minutes about a company that I co-founded called Doc2Doc Lending. We're a lending platform, completely fintech and virtual, for health professionals now. We used to say for doctors only, but we're expanding our market to cover other advanced practice providers. I'll tell you that most people, when they think of doctors, they don't think of us as needing money. And most people know of student loans and mortgages for physicians, but there's this sweet spot that exists that I lived through the pain point myself. I went to Emory here in Atlanta for medical school and matched into Harvard for my residency in anesthesiology 10 years ago now. And I was surprised that when I needed to pay for that relocation expense to go from medical school to residency, and residency is also schooling, but you get paid a little bit while you're training there, that the banks viewed my application for a $17,000 loan for a first last month's rent broker fee as a tall ask from a high-risk borrower, because I had $212,000 of student loan debt. I had an income at Harvard, I was going to be $13 an hour, and my FICO score was in the mid-600s. So on paper, I'm a bad bet. I'm an ugly duckling, so to speak. The lenders like to wait until you mature into making north of $400,000 as an anesthesiologist before they'll give you a loan to borrow in the marketplace. So what we do is we underwrite our loans more thoughtfully. We care that you're going to be an orthopedic surgeon. If you're in Arizona, you're going to make $680K, and we can underwrite based upon your future income potential. We can then also lend down to a lower FICO profile, knowing that the default rate for a 620 doctor is not like a 620 anyone else, and protect our investors' money, and we've seen that already. My co-founder had a different use case. So I don't want you to think that the only reason a borrower is a doctor is that moving relocation from medical school to residency. He had 2 kids in Boston with me while he was in residency, had a 3rd in fellowship, and was at the poverty line for a 5-person household with his wife and lived off of credit cards. This is one of the sad realities of medical training and education in the US, that it's extraordinarily expensive. We're collectively mortgaging our youth to then enter into a field to help society. Now, the biggest issues here, the pain points are, like I said before, we've got busy schedules, so it's hard to go into a bank and apply for a loan when you're on call and working nights and weekends. We also have this delayed maturation in our credit profiles. So if you think of the average American FICO profile compared to a physician that comes out of training in their mid-30s and cannot meaningfully apply and get approved for a loan for a mortgage or for a car loan because they're suppressed because of all the financial toll that it takes to get through that medical training. Now, what do? We have a fintech-based platform. It's all virtual online. You can apply on our platform, get approved within a matter of minutes, if you will be approved, by us using an API plugin that goes back to the Federation of State Medical Boards, so we can verify that you are a doctor. We can check to look at your insurance claims to see if you've got any pending litigation, one of the biggest reasons for doctors to default on their loans. We can also do a quick ID verification to avoid the bots and the spammers and the scammers out there using Plaid, so we can see their income profile as it is today, and our algorithm can tell us who they will be in a matter of years depending upon where they are in their training. Now, we can do all of this and fund the product within 3 to 5 business days without ever having them come into our bank or to meet us in person. We issued our very first loan in a pilot to a Cornell medical student back in 2019. We did $2.3 million in loans our very first year under a bank lender model. And we have over $140 million in loans outstanding today over the course of 4 years. So our concept caught on fire and took a hold. Here's the market sizing of this. The existing consumer lending, this is now unsecured personal lending for health professionals. So it's not your mortgage, it's not your student loan, it's the life happens in between. Your basement floods while you're in training, you need to borrow a couple of dollars to buy shares into the practice that you work for. It is paying for weddings. A big use case today is oocyte cryopreservation or fertility treatments. It's our female colleagues who are going to do a long training program like orthopedic surgery. It's going to take them 12 years. They're freezing their eggs. That costs $30,000. They'll borrow from that use case. Now, that's a $5.7 billion market if you think of the way it exists today for just consumer loans. If you include the expanded health professionals, think of the nurse anesthetists, the nurse practitioners, the physician assistants, the podiatrists, the optometrists, that increases the TAM to 17.5 billion, and we're in the brink of entering that market right now. But then you expand beyond just the consumer loan, and you think about all the things that I had to do to open up my first surgery center. It is merchant services, credit card processing. It's commercial loans for the build out of the surgery center. It is the equipment financing as well. You add those other products on there, and it's a $90 billion market. So if you think of how we make money today, that is a fraction of the enterprise value driver in the future. The biggest value driver here is the lifetime value of our customer. We've got the most money-thirsty consumer profile within a physician who will need to borrow $15,000 to go from Atlanta to Boston like I did. They'll need to refinance $270,000 student loan debt in a matter of 3 years after that borrow. They'll need to get med-mal insurance, disability insurance, term life insurance, whole life insurance, commercial loans, and a plethora of products. So the LTV, the lifetime value of our customers to a bank or a bigger lender is immense. And we intend to be acquired by a strategic by building this market out and then having them offer additional products as we continue to grow. Our product today looks like this. We'll lend between $5,000 and $25,000 if you were who I was when I needed to borrow the money, in training, still figuring out schooling. If you're already established, we'll lend you up to $100,000 if you meet certain underwriting criteria. Our rates start at 8.9% and it goes to 25.9%. A few years ago, folks would balk at the rates, but if you know where the markets are right now, this is, again, an unsecured loan. We're not underwriting your home. We're not asking for your business statements and P&Ls. This is all based upon underwriting the individual. We only have the credit reporting to protect us should a borrower default. So we're charging for that risk. And again, the default assumptions for us, it's extraordinarily low compared to other lenders. So while you're a 620 FICO borrower with us, no one else will lend to you. We will. So you'll likely qualify for a 24.9% interest rate. But the default assumption there is still they're going to default at less than 3%, which protects our investors' investment, but also creates a healthy profit margin for us, and it provides a service that they couldn't get anywhere else. This is what our growth has looked like, as I mentioned before. We have funded over 140 million in loans. We've processed now over 12,000 applications with requests of over $370 million for funding. We can expand our funnel and go further downstream in risk if we chose to do so, because we have figured out pricing for risk already. But we like being at pitches and saying we have best-in-class default performance, and we can protect our investors' money and think about risk and expanding the market at a future time. How do we acquire our customers? I think this is the part that's most valuable for us compared to other lenders. We've got quite a bit of volume from digital, and that's par for the course for others like Upstart and SoFi. But if you look at partnerships and school relationships, one of the challenges for a traditional lender is they're not able to go into a hospital or a medical school and market to those students because of the laws that protect industry from health professionals. The days of pharmaceuticals going in and paying for ski trips for doctors that influence how they prescribe has now prevented lenders from going in front of the students. I am there as a peer, or my team is. We're peers to those students. We share our personal experiences as a way of educating them in finances. And yet, I have a conflict disclosure slide that says, I'm the CEO of Doc2Doc Lending, and you see the entire room of kids take out their cell phones, take a picture, and we see our website traffic increase in real time. We're not also speaking at conferences as only vendors in a vendor hall. We're on stage as speakers, helping to educate the masses. And so These partnerships are critical to our model and how we succeed and beat the banks as well. Now, if you look at our portfolio, you'll see that we've got a tremendous amount of our borrowers, 88% compared to industry average of closer to 40%, that are on auto pay. And it's just routine payments coming in on time as our fund continues to grow and perform. Our default assumption is 3%. SoFi, they lend down to a 680 minimum FICO compared to my 600. Their default performance is 6.8%. So we're better than the best in class, the belle of the ball, at loan performance while serving, on paper, a riskier population. Our team. So it's a doctor-led and run company. Our investors, to date, we've raised $21 million in equity from doctors almost exclusively. We've raised $150 million in warehouse credit lines and loan purchase agreements from a bank in New York called DR Bank and a credit fund in California as well. But we are currently in a $5 million raise, of which we're doing $2 million in crowdfunding, and we're just at about the halfway mark. Doctors support us. They get who we are. They market for us when they invest because they understand the company's mission and vision. It's a for us, by us company. That being said, it's run by professionals. So I'm not pretending to know how to underwrite risk. I've got a guy from Bank of America Merrill Lynch and Chris Kronk, who was a managing partner when he left. My head of tech comes from Kiva and Fairbank. Head of strategy came from Kiva as well, Capital One, Synchrony. We've brought in industry professionals to help us run the company, and they've done a fantastic job so far. That's more Google and Sparkloft. Our advisory board are also professionals that help us to get into those relationships that allow us to have enterprises that employ physicians use us as a benefit program for their doctors and employed staff. That's a part of the reason why we want to lend to more than just doctors, because if a hospital says, let's bring Doc2Doc in-house, we don't want them to only market our product to the highest earners, they're the physicians. We know they're going to have nursing staff and other ancillaries that need loans, and if it's a payroll-attached loan, it becomes a safer bet for a riskier part of the population. On the roadmap, we're going to be doing some tech enhancements to our mobile app and a borrower portal, so our members can see additional offers. We can do the cross-sell beyond our primary product to ensure that we capture as much of that LTV as possible within our existing ecosystem. This is our financials. We also filed Form C. We're Reg CF on our raise, and so we've got more prospectus and financials online for you to evaluate as well. And finally, the best part of what we do is the fact that our customers are extraordinarily loyal to us. We have a 1 in 3 return customer rate. So if you come to us one time, 30% come back to us. It's 4.9 Trustpilot reviews, and for lenders that do fintech online, we're best in class in this as well, and it helps to kind of fuel our mission. It's been now 4 years since we started, and our first cohort of borrowers have now become investors in this cycle, which is something that we're extraordinarily proud of. If you use our product, you understand why it works, you understand why we matter, and it's been an incredible journey thus far. Hope to have you on along with us as well. I'll take questions.